There is a deeply seductive narrative embedded in retail investing. It sounds rational, safe, and almost guaranteed, which is exactly why so many disciplined investors cling to it for years while quietly underperforming. The story is called passive income. The promise is simple: buy quality dividend stocks, hold them forever, and collect steady cash payments without ever touching your principal. The vision feels tangible. You imagine financial independence funded by quarterly deposits that arrive like clockwork. Your capital, in this story, remains intact while income flows effortlessly. Dividends feel like interest from a savings account or rent from a perfect tenant, as long as you never sell shares. It appears your wealth is preserved and the payouts up your surplus. This belief has become foundational within dividend-focused investing communities, where selling shares is treated almost as a mistake and yield is elevated to a primary objective. Yet this mindset may represent one of the most expensive psychological errors in modern finance. Dividends are not free money. They are not a bonus. They are a partial distribution of your own capital. When a company pays a dividend, it transfers cash from its balance sheet to shareholders, reducing its intrinsic value by the same amount. Your brokerage balance rises, but the company's assets decline in taxable accounts. The transfer also triggers immediate tax liability. You have not created wealth. You have merely reallocated it, often with friction. To understand this clearly, emotion must be removed. A stock is not a bond with interest attached. It represents ownership in a business. Imagine you own a private company worth $1 million in cash. If you distribute $100,000 to yourself, the company is now worth $900,000. Your total net worth remains unchanged. This is precisely what happens on the ex-dividend date. Markets automatically adjust the share price downward by the dividend amount. If a stock trades at $100 and pays to dollars, it will open near $98 the next day. The market reflects the company's reduced asset base. No value has been created. Part of it was simply distributed. Despite this, investors instinctively separate income from principal. Behavioral bias causes dividends to feel safer than selling shares. Yet in an era of zero-commission trading and fractional shares, there is no mathematical difference between receiving a 4% dividend and selling for percent of your holdings. In both cases, portfolio value declines proportionally. This leads to the concept of the homemade dividend. Any investor can generate cash flow by selling a small portion of a portfolio, unlike corporate dividends. Self-directed withdrawals offer flexibility. You control timing, size, and tax impact. Dividends, by contrast, arrive whether you need them or not, often creating unavoidable tax consequences. Selling strategically allows you to manage capital gains, choose higher cost basis shares, or defer realization during high-income years. This flexibility compounds over decades. Dividend-heavy strategies, especially in taxable accounts, introduce persistent tax drag that meaningfully reduces long-term total returns compared to growth-focused, tax-aware approaches. Furthermore, generous dividend policies can signal limited reinvestment opportunities in high-growth phases. Leading companies typically reinvest profits internally because management believes retained earnings can generate superior returns when a firm distributes substantial cash instead. It may indicate fewer productive avenues for expansion and innovation. Chasing high yields often leads investors into value traps. Mature or declining industries distributing cash while long-term competitiveness erodes. The yield appears attractive, but underlying growth stagnates. In such cases, dividends can mask structural weakness, creating the illusion of income stability while intrinsic business value slowly deteriorates. Total return, not dividend yield, is the metric that truly matters. Total return combines price appreciation with reinvested dividends. A stock yielding 10% but losing 5% annually delivers only 5% net growth. Meanwhile, a company reinvesting profits to grow at 10% annually creates superior long-term wealth. Even without payouts, retirement expenses are funded by equity, not yield alone. selling a small portion of a growing portfolio can provide sustainable income while preserving long-term expansion. Prioritizing dividends for psychological comfort often sacrifices broader market performance. Investors may unknowingly trade compounding potential for the reassurance of visible cash flow. Consider Warren Buffett's approach. Berkshire Hathaway has never paid a dividend despite holding immense cash reserves. Buffett understands that retaining earnings within a highly efficient capital allocation engine can create greater shareholder value than distributing taxable income. Compounding inside the business often outperforms forced distributions. Breaking the dividend illusion requires reframing perspective. View dividends not as paychecks, but as automatic partial sales initiated by management. Build a diversified portfolio based on long-term growth potential rather than payout policy. Generate cash intentionally and strategically. Wealth is built through mathematics and discipline, not comforting narratives. If this shifted your thinking, subscribe for more evidence-based investing insights. Another overlooked factor is opportunity cost. Every dollar distributed as a dividend is a dollar that cannot be reinvested internally at potentially high returns. If management can deploy capital at 15 to 20% returns in new projects, acquisitions, or innovation, distributing cash prematurely may cap long-term compounding. The true cost is not the payout itself, but the growth that never happens. There is also this signaling illusion. Investors often interpret dividend increases as proof of strength, yet companies are reluctant to cut dividends once established. This creates pressure to maintain payouts even during weaker periods, sometimes leading to debt issuance to fund distributions. In extreme cases, protecting the dividend becomes more important than protecting the balance sheet. Buybacks further expose the inconsistency in dividend thinking. When a company repurchases shares, investors rarely complain about not receiving income, even though buybacks also return capital. Both mechanisms distribute value. The difference is perception. Dividends feel tangible. Buybacks feel abstract, yet both reduce corporate cash and alter capital structure. From a portfolio construction perspective, concentrating solely on dividend payers narrows your investment universe. Many of the most transformative companies in history paid no dividends during their most explosive growth phases. Excluding them in favor of yield can structurally limit exposure to innovation, productivity gains, and sectoral shifts driving global economic expansion. Ultimately, investing is about maximizing after-tax, risk-adjusted total return over decades. Psychological comfort should not override arithmetic reality. Dividends are a tool, not a strategy. When evaluated objectively, they neither create nor destroy value on their own. What determines success is capital allocation, tax efficiency, diversification, and disciplined decision-making over time.